You know, when we talk about the future right now, everybody seems to be picturing, well, the exact same thing.
Oh, yeah, the sleep glowing screens.
Right. It's a weightless cloud. It's some highly intelligent AI chatbot just, instantly answering your deepest questions. We tend to treat the digital world like it's magic, like it just exists in the air around us.
Yeah, and that physical reality is entirely missing from the mainstream tech conversation.
Yeah.
I mean, the cloud is honestly a terrible metaphor.
He really
The
is.
cloud is not in the sky. It is a
Uh-huh.
massive, incredibly loud, incredibly hot building sitting in a field somewhere, and the physical infrastructure required to keep it running is just staggering.
Exactly. So today we are going to look at the dirt under the fingernails of the digital age. Because to make that glowing screen work, someone actually has to go out into the physical world, dig a trench, pour the concrete, and, lay the high voltage cable.
Someone has to actually build it.
Right. And to show you how lucrative that dirt can be, we are tearing into a company called Quanta Services today. You rarely hear their name on the evening news, and they operate almost entirely behind the scenes, but they are literally building the physical backbone of our modern world.
Yeah, they really are the invisible giants here.
So to do this, we are pulling from Quanta's brand new Q1 2026 earnings release, which just dropped today, Thursday, April 30th, 2026. And we're pairing that with their deeply dense 43-page SEC Form 10Q filing.
Which is quite the read.
No, it's a lot. And honestly, just getting my hands on this data felt a bit, I don't know, ironic. I had to pass one of those Cloudflare security verifications on MarketBeat, clicking all those little boxes with the traffic lights and the
So
crosswalks.
to prove you weren't a bot.
Right. I had to prove I wasn't a bot just so I could download financial data about the company that is building the physical infrastructure to power the bots.
Ah, right. The gatekeepers of the digital realm, making sure you're human before you can research the humans keeping the digital realm alive. It's perfect.
It really is. So that's our mission for you on this deep dive. We are going to decode the financial numbers of this invisible giant and show you how the unseen infrastructure all around you, from high voltage transmission lines to data center cooling systems, is driving billions of dollars in growth.
Because while everyone else is distracted by the shiny new software update, the smartest minds are looking at the companies digging the dirt and laying the pipe.
Okay, let's unpack this, because we really need to start with the sheer mind-boggling scale of what Quanta is doing right now.
Yeah, the numbers are huge.
Looking at this Q1 2026 earnings release, they reported consolidated revenues for the first quarter of $7.87 billion.
Wow.
Yeah, let's just round that to $7.9 billion in 3 months. That is a 26.3% jump from the exact same quarter last year.
Which is just a massive acceleration for a company of this size.
Yeah.
I mean, growing over 26% at that scale is wild. And, it flows straight down to their bottom line. Net income hit $231.4 million. But you have to look closely at the per share numbers because there's a really fascinating gap there. Their GAAP diluted earnings per share, which is the standard accounting metric, was $1.45.
Okay.
But their adjusted EPS was $2.68, which is almost double.
Yeah, I noticed that gap when I was digging into the 10Q.
Yeah.
Usually a massive difference between GAAP and adjusted earnings means a company is, well, backing out some heavy one-time expenses. Why is it the huge discrepancy here?
It mostly comes down to how aggressive they are being with acquisitions.
Oh, okay.
Yeah, when a company buys other businesses at the scale Quanta does, they accumulate a massive amount of intangible asset amortization.
Right.
It's basically an accounting mechanism that legally drags down their official GAAP earnings on paper, but it doesn't actually impact their day-to-day cash flow. The 2.68 adjusted EPS gives you a much clearer picture of the actual cash they are generating from their operations.
That makes a lot of sense. This is essentially a paper drag, not real cash flying out the door. But, even those revenue numbers pale in comparison to the metric that really made my jaw drop. The backlog.
Oh, the backlog is incredible.
Their backlog, which is, for those who don't know, the amount of work they have booked and contracted but haven't actually started or finished yet, is sitting at an eye-watering $48.47 billion.
It's hard to even wrap your head around that number.
Right, and that is up over 10% just since December of 2025. A $48 billion-dollar backlog is like having your calendar fully booked with high-paying, uncancelable gigs for the next several years.
Yeah, it's job security on a corporate scale.
But what exactly are they booking? I mean, are they just putting up telephone poles and digging ditches?
Well, if we connect this to the bigger picture, this is far beyond routine utility maintenance. We have to look at how they divide their business to see what's really driving this.
Okay, break that down for us.
They operate in two main segments. The lion's share is electric infrastructure, which accounted for $6.47 billion of their revenue this quarter alone.
Wow, so the vast majority.
Yeah. And the second segment is underground utility and infrastructure, bringing in about $1.4 billion. That $6.47 billion electric segment is basically Quanta riding a macro supercycle.
A super cycle of what exactly?
It's a convergence of general grid modernization, severe weather hardening, and the massive push for electrification.
And we know the broad strokes of electrification, right? The world is moving toward electric vehicles and heat pumps and transitioning away from fossil fuels.
Right, exactly.
But that transition has been talked about for like a decade now. Why the sudden 26% revenue spike right now? Why is it hitting so hard in Q1 of 2026?
Because we've finally hit the physical bottleneck.
Okay.
You can mandate all the electric vehicles you want, but you can't just flip a switch and magically push twice as much power through a grid that was built in the 1970s.
The wires would just fry.
They will literally melt.
Yeah.
Utilities are realizing they are completely bottlenecked. They need new substations, massive upgrades to distribution infrastructure, and heavy-duty transmission lines just to handle the baseline demand we are projecting.
And Quanta is the company physically building the capacity to relieve that bottleneck.
Precisely.
So we think of tech as this weightless, ethereal thing, but the reality is the cloud is incredibly thirsty and power-hungry. Which brings me to something interesting I saw when I was digging into their underground utility segment.
Oh, the DSI acquisition.
Yes, the $1.26 billion acquisition of Dynamic Systems, or DSI, from July 2025. DSI specializes in turnkey mechanical and plumbing infrastructure.
Which seems like a weird fit at first glance.
Totally. When I see a high-voltage electrical contractor buying a plumbing company for over $1 billion, my first thought was, why does the AI boom need toilets?
Right. Doesn't make intuitive sense.
But reading the 10Q, it looks like this is actually about liquid cooling for servers. So are they basically acting as the ultimate heavy-duty plumber for the internet?
You're spot on about the cooling, but it's not just water running through standard pipes. A modern AI data center is fundamentally a massive thermodynamics problem.
Thermodynamics.
Yeah. Thousands of high-performance servers running complex AI models generate an unbelievable amount of heat. If you don't remove that heat instantly, the silicon physically degrades and melts. Traditional air conditioning just doesn't cut it anymore.
Right. Fans blowing cold air just aren't enough for these new chips.
Exactly. They need industrial-scale, closed-loop, liquid cooling systems directly chilling the racks.
So highly complex HVAC and process piping.
Right. And by acquiring DSI, Quanta executed a brilliant strategic pivot. They didn't just stay outside the building, stringing the high-voltage power lines to the data center.
They bought their way inside the building.
Exactly that. DSI contributed $335 million to Quanta's revenue this quarter alone, specifically targeting the technology, semiconductor, and data center markets. They are now capturing the capital spent on both sides of the concrete wall.
That's genius. They're capturing the energy flow all the way from the generation source, right down to the chilled water hitting the AI processor. Yeah. And speaking of the generation source, the sources point out that the renewable energy boom is playing heavily into this super cycle as well.
Yeah, because the physical reality of green energy is highly location dependent.
What do you mean by that?
Well, the most cost-effective places to generate wind and solar power, like wide-open plains or sunny deserts, are usually hundreds of miles away from the dense urban centers and data center hubs that desperately need that power.
Ah, right.
A massive wind farm is completely useless if it's stranded from the grid. Connecting those remote power sources requires long-haul, high-voltage transmission lines, and that is Quanta's bread and butter.
It's fascinating how tangible this all is. We talk about the green energy transition as a lofty ideal, but it really comes down to, well, miles of physical wire and steel.
It really does.
But altering the physical world comes with immense physical realities and liabilities. Here's where it gets really interesting, because the physical world is entirely unpredictable. Take the weather, for example.
Oh, weather is a huge factor.
Right. Historically, the first quarter of the year, January through March, is Quanta's weakest quarter.
That's pure operational reality. Cold, snowy, wet weather just ruins construction productivity.
Right, you can't exactly work fast in a blizzard.
No, you cannot safely operate heavy machinery in a flooded trench or string high-voltage lines when there's ice everywhere.
Yet, despite Q1 being their historically weakest quarter, they still hit nearly $8 billion in revenue. That tells me the demand for their services is so overwhelming, it's pushing right through traditional seasonal slowdowns.
It's unstoppable momentum right now.
But weather isn't just a delay factor, right? It can be a catastrophic liability. I was reading through the legal proceedings section of the 10Q, and I found the details on the Silverado 5 litigation.
Yeah, that is a critical case study in the hidden risks of this industry.
Break that down for us because it's wild.
So the Silverado fire burned about 13,000 acres in Orange County, California back in October 2020. Currently, Southern California Edison, the local utility, and T-Mobile are locked in a massive lawsuit over how it started.
Over whose equipment failed, basically.
Right, they're arguing over whose equipment failed on a shared utility pole during high winds.
But Quanta isn't a utility, and they aren't a telecom provider, so I assumed they wouldn't be involved at all, but they are getting dragged into this through subrogation claims.
Yes, subrogation.
Let's pause on that word for a second. For anyone who hasn't spent time dealing with insurance adjusters, that essentially means the utilities insurance company is looking for someone else to foot the bill, right?
That's the practical translation, yeah.
Yeah.
Subrogation is the legal mechanism where an insurance company pays out a claim to their client, but then sues a third party they believe is actually at fault to recoup their money.
So they're coming after the contractors.
Exactly. Southern California Edison is using subrogation to drag Quanta subsidiaries into the lawsuit because a Quanta contractor was the one who replaced those specific utility poles.
And the detail that completely blew my mind in the 10Q is the timeline.
Oh, the 19 months.
Yes. Quanta's subsidiary replaced those poles in March of 2019. That is 19 months before the fire even happened.
Yeah, a year and a half later.
I mean, if I build a wooden deck for a homeowner and a year and a half later their house catches fire, I wouldn't expect my contracting business to be sued for the damages. How does a company even price in the risk of multi-million-dollar wildfire liabilities when taking on a physical job?
Well, what's fascinating here is how they mathematically construct their business model to survive those exact tail risks. To understand that, you first have to look at how they bid for work.
Okay, how do they do it?
Over 60% of Quanta's revenue comes from fixed-price contracts.
Meaning, they look at a massive infrastructure project, bid a single specific dollar amount, and if the project ends up costing more, Quanta just eats the difference.
Yeah, exactly.
Why would they take on so much risk? Why not just charge hourly for materials and labor?
Because of the clients they serve. Utilities are heavily regulated by government bodies and public utility commissions.
Oh, right, regulators.
Yeah, a utility can't just arbitrarily raise the price of electricity on consumers whenever a construction project goes over budget. They need absolute cost certainty to get their rate bases approved by regulators.
So the utility forces the risk onto the contractor.
Precisely. The only way the utility can guarantee that certainty is by shifting the financial risk of inflation, supply chain delays, and weather disruptions entirely onto contractors like Quanta through fixed price agreements.
Wow, so the entire modernization of the grid relies on contractors being willing to gamble on their own cost estimates. But how do they manage the catastrophic tail risks, like a wildfire subrogation lawsuit?
That requires a very specific financial setup.
Because a bad inflation estimate might cost them a few million, but a wildfire could bankrupt a normal company. The 10Q notes they're defending the Silverado pace vigorously, but how do they financially shield themselves from an event like that?
Through a highly sophisticated financial mechanism called a captive insurance company. Quanta wholly owns its own insurance provider.
Wait, they own an insurance company? So think of a captive insurance company like a corporate piggy bank for disasters. Instead of paying massive, unrecoverable premiums to an outside insurance corporation to cover every little accident, Quanta takes that premium money and pays it to themselves into their captive subsidiary. Am I looking at that right?
You get the exact mechanism. It acts as a massive financial shock absorber.
Okay.
They combine this captive insurance with incredibly high deductibles. For general and auto liability, Quanta can retain risk up to $70 million per occurrence.
$70 million out of pocket for a single incident before their outside catastrophe insurance even kicks in.
Yes, $70 million per event.
That is insane. If my car insurance had a $70 million deductible, I'd never drive.
Well, it forces an absolute obsession with safety and operational excellence. If a normal contractor has a $50,000 deductible, they might get a little sloppy. When your deductible is $70 million, your safety protocols have to be flawless.
I bet.
They are balancing the mathematical risk of taking on $70 million hits against the exorbitant cost of buying excess insurance in the open market. It's the hidden financial engineering required to pull off the physical engineering.
But if you are self-insuring up to $70 million per wildfire or major accident, you can't be living paycheck to paycheck as a business. You need an absolute fortress of a balance sheet just to prove you can absorb that kind of hit.
Which explains the mountain of cash they are currently managing.
Exactly. Looking at Q1, their operating cash flow jumped 61% year over year to $391.7 million.
Their liquidity position is just immense. If you combine their credit facility with their cash on hand, their total available liquidity sits at $2.82 billion.
Nearly $3 billion in liquidity, and they are returning some of that to shareholders, right? They paid out $17.2 million in dividends this quarter.
Right?
But here's the section of the 10Q that made me stop and reread the paragraph.
The stock buybacks.
Yes, they have an active $500 million stock repurchase program authorized by their board, with $365 million remaining. But during the entire first quarter of 2026, Quanta didn't buy back a single share on the open market. Zero.
Yeah, that is a glaring detail. When a company is generating that much cash but actively chooses not to execute an authorized buyback, it really demands analysis.
Management is making a very deliberate statement with their capital.
Definitely.
So what does this all mean? They have authorization to buy back their stock. They have nearly $3 billion in liquidity. Their backlog is bursting at $48 billion. But they kept their wallets shut in Q1. Do they just think their own stock price has run up too high to be a good value?
Well, this raises an important question, and that is the most straightforward conservative deduction.
Okay.
The market has been incredibly enthusiastic about AI and green energy infrastructure. Management might simply feel the current share price already reflects that optimism, making buybacks an inefficient use of capital at this exact moment.
That makes sense.
But you have to look deeper at the warnings they put in the 10Q.
You're talking about the forward-looking statements. They repeatedly highlight supply chain disruptions and inflationary pressures.
Exactly. Those aren't just boilerplate warnings. Remember, 60% of their revenue is locked into those fixed price contracts we talked about.
Right.
If management sees early indicators that the cost of copper, steel, or labor is about to spike, or that supply chains are tightening, hoarding cash is a vital defensive maneuver.
So they need that liquidity to fund their working capital so they can execute on that $48 billion backlog without taking a massive margin hit.
Precisely. It's a buffer.
So it's a defensive cushion. Keep the cash on hand just in case materials cost more to secure. But, I'll throw out a third deduction here. They are keeping their powder dry for offense.
Oh, for another acquisition.
Yeah. We just talked about how they dropped $1.26 billion on DSI to vertically integrate into data center cooling. It is entirely possible they aren't buying back stock because they have another massive strategic technology infrastructure target in their crosshairs, and they need the cash ready to deploy.
That is a very strong possibility. The infrastructure landscape is consolidating rapidly right now.
It really is.
The companies that can offer an end-to-end solution from the high-voltage transmission tower miles away down to the chilled water pipes inside the server room are going to command the premium contracts. Quanta has proven they are willing to buy their way into those lucrative bottlenecks.
It's the ultimate game of financial chess, played out with excavators, insurance calculus, and copper wire.
Well put.
It really changes how you look at the whole technology sector. We started this deep dive looking at a company that flies completely under the radar for the average person. But parsing through Quanta's Q1 2026 filings, we've found hard proof that the AI revolution and the green energy transition are not just concepts existing in the ether.
They are massive, deeply physical events.
Right.
The constraints on our digital future aren't going to be software limitations. They're going to be physical limitations. They require billions of dollars of tangible wire, pipe, and concrete.
Yeah.
And more importantly, they require companies willing to take on the massive environmental and legal liabilities necessary to build it, navigating everything from frozen ground to the threat of wildfire subrogation.
For you listening, this is a profound shift in perspective. It's a reminder that true tech investing, or even just understanding where the global economy is actually moving, might mean looking away from the software developers in Silicon Valley and looking toward the dirt under the fingernails utility contractors.
Absolutely. The people laying the foundation and managing the physical risk, might just be the ones holding the safest bets.
The physical infrastructure is the absolute bottleneck for the digital future. You can write the most elegant, highly optimized AI code in the world, but if you don't have the electrical capacity and the industrial cooling to run the servers, your code is useless.
And Quanta is clearly positioning itself to own that bottleneck.
And that leaves us with a final thought to chew on. As our digital lives demand exponentially more physical infrastructure, more raw power, and more cooling, will the companies that physically lay the cables and own the pipes eventually hold more leverage than the companies that write the software?
It's a great question.
I mean, it is relatively easy to build a new app. It is incredibly hard, legally perilous, and massively expensive to build a high-voltage transmission line. So next time you fire up an AI chatbot, ask yourself who built the plug it's connected to. Thanks for diving deep with us today. We'll catch you on the next one.